Welcome to today's Explainer. We're diving right into a fascinating story about finding the absolute perfect economic balance. We hear the word inflation thrown around constantly, on the news, at the grocery store, around the dinner table. But today, we're going to strip away all that complex jargon. We're looking at inflation for what it really is, a decades-long, high-stakes quest by the world's central banks to find the exact right temperature for our global economy.
To really grasp why this matters so much, let me hit you with a number: $320 billion. Now, that's not some country's national debt, and it's definitely not the valuation of a massive tech company. That was the literal cost of a single ordinary egg in Germany back in 1923.
To ground this massive, kind of abstract economic concept into a tangible daily reality, let's look at how that actually happened in Germany. In June of 1912, an egg cost just 7 Pfennig, which is basically pennies. Fast forward to August 1923, and it was over 900 marks. By October, 227 million, and by November, a staggering 320 billion marks. It's wild, right? This brilliantly illustrates how quickly your purchasing power can just completely evaporate when inflation spirals out of control. It's a total collapse of daily life.
All right, so here is our roadmap for today. We're going to cover 1. The cost of daily goods. 2. The impact on savings and debt. 3. The 2% target. 4. The central bank toolkit. And finally, 5. Future targets and climate goals.
Section 1. The cost of daily goods.
So at its core, inflation is simply the rate at which the general level of prices for goods and services goes up, which ultimately decreases the purchasing power of your money. Think about a standard haircut or a loaf of bread. If a loaf of bread cost $1 a few years ago, and today it costs $2, while the bread itself hasn't changed, it hasn't magically become twice as nutritious or twice as large. Rather, the money you're holding has actually lost value. It takes more of it to buy the exact same daily item.
So why does this happen? Economists generally break this down into 2 main drivers. First up, there's demand pull inflation. Think of a booming economy where everyone has cash to spend, but there are only so many goods on the shelf. As the old saying goes, it's too much money chasing too few goods, and that naturally drives prices up. The second is cost push inflation. This is when the cost to actually make the goods goes up. Maybe raw materials get super expensive or worker wages increase. So businesses are basically forced to push their prices up just to maintain their profit margins.
Moving on to Section 2. Impact on savings and debt.
Here is a crucial point that really hits close to home. Unanticipated inflation creates distinct winners and losers. For savers and creditors, let's say you have cash stuffed under a mattress or you're living on a fixed retirement income. Inflation acts as this invisible tax. It quietly destroys the purchasing power of your life savings. But for debtors, it's a different story. If you locked in a fixed-rate mortgage years ago and inflation suddenly spikes, you're actually paying back that loan with cheaper money. In certain economic conditions, it almost acts like an interest-free loan from the bank. Crazy, right?
But we really have to look beyond just individual winners and losers. Unchecked inflation physically widens the gap between the rich and the poor. Everyday consumers and retirees are definitely the most vulnerable because their wages rarely keep pace with the rise in cost of groceries and rent. Meanwhile, wealthier individuals might hold assets like real estate that actually go up in value right alongside inflation. So managing this isn't just an economic exercise. It's absolutely crucial for social equality.
Section 3. The 2% target.
The journey to the modern global standard we use today actually kicked off in 1990. The Reserve Bank of New Zealand became the very first to adopt an explicit inflation target. The Bank of Canada followed suit in 91, then the Bank of England in 92. By the late 1990s and 2000s, heavyweights like the European Central Bank and the U.S. Federal Reserve had aligned with what became the universal gold standard, the 2% target.
Now, you might be asking, why exactly 2%? I mean, why not 0? Well, 0% flirts dangerously with deflation. Think about it. If people expect prices to drop tomorrow, they're going to stop spending today. The whole economy freezes up, it gets way too cold. But 2%? That's the Goldilocks zone. It's low enough to protect your savings from hyperinflation, but it's just high enough to encourage spending and stimulate economic growth. Plus, let's be honest, getting a 2% raise every year just feels like progress, even if it's really just matching the cost of living.
Which brings us to Section 4, the central bank toolkit.
So when inflation starts running a bit too hot, central banks use what's known as contractionary monetary policy.
They basically have three main tools to pull money out of the economy and cool things down. Number one, they raise short-term interest rates. This makes borrowing money for a house or a new business much more expensive, which cools down demand. Number two, they raise reserve requirements, forcing banks to lock up more of their deposits instead of lending them out. And number three, they use open market operations. This means they sell government securities to investors, which literally absorbs excess cash right out of the financial system.
And hey, this isn't just an American or European tactic either. Whether it's the Fed in Washington or the central bank in Fiji, they utilize these exact same open market operations, buying and selling securities to align their interbank rates with their ultimate policy goals. It's a truly global playbook. But how these tools are actually applied, that can vary wildly. Take reserve requirements, for example. Brazil mandates that banks hold 21% of their deposits in reserve. China sits around 6.6%. But in the USA and Canada, they currently sit at 0%. They rely almost entirely on adjusting interest rates and those open market operations rather than locking up specific percentages of bank deposits.
Of course, it's vital to remember that this economic medicine comes with some pretty severe side effects. Yes, the intended cure stabilizes prices and reduces inflation, but by intentionally pulling money out of the system, central banks are actively trying to slow down economic growth. That means companies halt expansions, which unfortunately leads directly to increased unemployment and reduced hiring. It is a really painful balancing act.
Finally, Section 5, Future Targets and Climate Goals.
The big question economists are wrestling with right now is this: will the 2% target even survive the modern era? I mean, with massive shifts in globalization, shattered supply chains, and entirely new global challenges, a lot of experts are beginning to wonder if a strict 2% target is simply too ambitious, or maybe even totally outdated for the world we live in today.
And here is a totally unexpected twist that very few saw coming. According to recent market analysis, modern central banks might soon have a massive shift in priorities. The thought is that in some cases, central banks have begun to pay greater attention to net zero targets and climate impact. It may be that they look to broaden their mandates further to include climate-related goals, which may actually reduce their focus on inflation.
Which leaves us with a truly provocative thought to end on today. Are we entering a brand new era where the pursuit of global sustainability forces us to just accept higher everyday inflation? If central banks prioritize green infrastructure and climate goals over strict price stability, the era of the 2% target might actually be over. And that means the transition to a sustainable future might just show up directly on your daily grocery receipt. Thanks so much for joining me on this explainer, and I really hope this gives you a whole new way to look at the economy.